Why position sizing matters more than entries. The Great Illusion. Most traders believe the secret to profitability is the perfect entry, the perfect breakout, the perfect pullback, the perfect indicator alignment. They believe that if they can just enter at the exact right moment, everything else will take care of itself. But here's the uncomfortable truth. You can have bad entries and still survive in this market, but you can have perfect entries and still blow your account. And that reality confuses people, because it means the market isn't rewarding intelligence the way we expect it to. The difference isn't where you enter, it's how much you risk when you do. Today, we're exposing why position sizing matters more than your strategy, and how ignoring it quietly destroys traders who think they're doing everything right. This is not a technical problem. This is a survival problem. Section 1. The Entry Obsession. Most traders spend years chasing the holy grail entry. They hop from strategy to strategy. They stack indicators. They tweak rules endlessly. Their charts become crowded, their confidence becomes fragile, yet their equity curve never stabilizes. Why? Because a perfect entry is a loaded gun when the position size is wrong. A small mistake with a large size becomes a catastrophe. A large mistake with a small size becomes a lesson. The market doesn't care how smart your analysis is. It doesn't reward effort. It doesn't reward intention. The market only reacts to risk exposure. You can be right about direction and still lose money. You can be wrong about direction and still survive. That alone should tell you where the real danger lives. Section 2. The Math of Survival. Position sizing is not a feeling. It's not confidence. It's not intuition. It's not excitement. It is a cold, unemotional calculation that answers one question. How much damage will this trade do if I'm wrong? Professional traders think in losses first, not profits. Before they even click buy or sell, they already know the exit. They already accept the loss. And if that loss feels too heavy, financially or emotionally, they simply walk away. No debate, no negotiation, no attachment. Even if the setup looks perfect. That discipline is not optional. It's a survival mechanism. Because the market doesn't destroy traders slowly. It destroys them when risk is ignored. And most traders are one bad decision away from ruin. Section 4. Why good trades kill accounts. Here's a reality most traders don't want to face. Most blown accounts didn't come from stupidity. They came from good trades. Trades that followed the rules. Trades that made sense. Trades that were just too big. When you over-leverage, a single loss doesn't just take your money, it takes your mental balance. Once fear enters the system, the spiral begins. You cut winners early because you're scared to lose them. You hesitate on valid setups because the last loss still hurts. You revenge trade because you want relief, not profit. And suddenly, your strategy didn't fail. You did, under pressure. The entry wasn't the problem. The size was the poison. Section 5. The Invisible Damage. The most dangerous part of bad position sizing is that the damage is invisible at first. You don't see it in one trade. You feel it across many. You start watching your P&L instead of price. You start managing money instead of managing risk. You start trading outcomes instead of executing a plan. Your psychology changes, not because the market changed, but because your exposure did. Too much size turns normal losses into emotional trauma, and emotional traders don't make rational decisions. They survive by luck, until luck runs out. Section 6. The power of being boring. Small position sizing feels boring. It feels slow. It feels insignificant. It feels like you're not making real money. But small size gives you something priceless: time. Time to learn. Time to make mistakes. Time to survive losing streaks. Trading is not a sprint to get rich. It's an endurance game designed to eliminate impatience. You don't need perfect entries. You need enough time for probability to work in your favor. Most traders fail not because they're wrong, but because they didn't survive long enough to be right. Section 7. The mental shift. When your position sizing is correct, everything changes. Losses become business expenses, not emotional events. Decisions become calmer. The need to be right disappears. You stop trading to prove something. You stop fighting the market. You start executing a process instead of chasing validation. That is the exact moment you stop being a gambler and start behaving like a professional. Survival is the edge. Strategies will evolve, markets will change, entries will come and go. But traders who master position sizing are the only ones still standing when the noise fades. Remember this: your account doesn't grow from perfect trades. It grows from controlled losses. Trade small, survive longer, and let the market reward patience.